Hi, I will just do this quick video for FAC 1501. Yeah, I will just make this. I hope you will see everything here. Yeah, so we are just going to do some basics of accounting. So it's going to be FAC 1501. Yeah, assignments or whatsoever. We're actually going to deal with the AOE. AOE meaning that its assets is equal to owner's equity plus liabilities. So just make this way. It's gonna be O plus L, actually not OE. So what is happening here is that, so you must know actually the definition of assets, owner's equity, and liabilities. Yeah? So let's start with assets. What are assets? What are assets? So assets, you know, is the ownership of the business. So it's what the business owns, the ownership of the business. And then you will have ownership of the business. It will include like something like vehicle, and then it will include equipment. It will include as well stock, of which is usually called inventory. So this is the most important part of the business, the inventory. Inventory, actually, it's what the business is selling. So if the business is selling cars, it means that the inventory of the business is it's vehicles or it's cars. Yeah? It's cars. So those are inventories. So you must take note of that, because the core existence of the business is inventory, is the stock or the trading stock, what the business is selling. And then there will be as well, so it's what the assets owns, assets. And then under assets, you know that you have NCA, you have CA, and what else? You have FA, yeah, and then we have IA. Okay, with the NCA, it's a non-current assets. This one, non-current assets, and then this one is current assets, and this one is financial assets. This one is intangible assets. Now let's continue. And now with the intangible assets, I've told you that financial assets, current assets, and non-current assets. Ne? Okay, with the non-current assets, you know, you have land. Ne? You have land, you have buildings. You have buildings. Yes, you have land, you have buildings. Okay, so I've told you that we have buildings, land and buildings. We have vehicle, we have equipment as well. So those are non-current assets of the business. Yeah, let's continue. So these are under non-current assets of the business. So let's just rehearse. We said that we have assets. Then I told you that we have NCA, of which is non-current assets. So we have non-current assets. Under non-current assets, I told you that we have vehicle, we have land, we have buildings, we have equipment, we have machinery. If the business is actually producing something, for sure the machines that are producing those things. We have as well furniture. Okay, you must bear in mind that when you speak about these non-current assets, non-current assets refers to assets that stays in the business for more than 1 year. So their lifespan is 12 months is 12 months, in fact greater than 12 months. Those are non-current assets. They can actually stay in the business for more than 20 years or 15 years or 10 years, as long as the assets will stay more than 1 year. That is called a non-current assets. Ne? Yeah, so it's very important to understand the definition of the non-current assets. And then we go to current assets. The first one is gonna be inventory. That's the first one, inventory. Then the second one is gonna be trade receivable. The third one is gonna be bank. These are the major current assets of the business. So inventory is what the business is selling. So if the business is selling sweets or selling cars, maybe selling tires, those are called inventories. It's what the business is selling for revenue purposes. Then we have your trade receivables. Trade receivables it's actually those customers that buys on credit that are owing you. In the past, this was called debtors. So you can write debtors there. It's what was called debtors in the past, but we have a new term. It's called trade receivables. Then you have your bank. Your bank is always current assets, unless you have a negative balance. Then if you have a negative balance, it would be a trade payable or current liability. It would go under liabilities. But if the balance is positive, so it would be called it will be recorded under current assets. Okay, so those are very important, and bear in mind when you speak about the current assets, you speak about the assets that stays in the business for less than 12 months. For less than 12 months. These are less than 12 months lifespan in the business. For example, inventories, you produce them during the year, but you'll be selling them during the year as well. So they can stay for more than 1 year. So if an asset stays for more than 1 year, it's no longer a current asset, but a non-current asset. Okay, then we are done with the current assets and non-current assets. Then we are dealing with AOE, right? AOL, in fact. Assets is called owner's equity plus liabilities. Okay, now let's continue. Okay, let's continue. Now, I am saying to you that we have dealt with current non-current assets. We have dealt with current assets. Now let's go to the owner's equity. Now, if you speak about equity, what do you speak about when you speak about equity? Equity is money that belongs to the owner. So this money does not belong to the business. It is owned by the owner. It's the owner's money. Now, now what is it that is in the owner's equity? Under owner's equity, we have capital. We have drawings. Ne? We have drawings. We have expenses. And then we have income as well. Those are the major components of equity. It's expenses, it's income, it's capital, and it's drawings. And now we have to understand the logical principle of owner's equity. Under owner's equity, you must know that we have what we call a T account. The T account summarizes the owner's equity. The T account, it has a plus on this side and a minus on this side. On the debit side, there is a decrease of the equity. On the credit side, there is an increase of the equity. Now, this is equity. I just write equity there. Now, on the credit side of the equity, we have what we call income. Ne? On the credit side, meaning that whenever a business is receiving money, so the equity is always smiling, it's because the income actually increases the equity. Then on the debit side, we have what we call the debit, that is, it decreases. Now will be expenses this side, expenses. expenses. So it means that whenever a business pays anything, that will decrease the equity on the debit side of the equity account. So in summary, you can say that expenses, they decrease equity, but the income, they increase the equity. So that's what we must actually get out of this principle of the equity. Okay, let's go and continue. Now, when it comes to the equity again, I've just told you that there is a debit and there is a credit. Now, what must be in your mind is that the debit side of the equity represents expenses, but the credit side of the equity represents incomes, because whenever there is a flow of income into the business, there is a plus and there is a minus there of the equity. Okay, now let's continue. Now let's look individually on the expenses, and let's look individually on the incomes. Let's start with the income. Now, income accounts, you know, there is a rent income. Income. This is an income account. Now, we must know that a rent income, it has a plus on the credit side, it has a minus on the debit side. Now, why? It's because the income is always interest on this side. Whenever a tenant or a person who are renting my premises as a business pays the rent, the business will always interest on the credit side. When a person pays the rent to my premises, I will have what we call a rent income, right? So it means that the rent income always interests on the credit side, whereas the expense that is, example, it will be advertising. If I pay advertising expenses, they will interest on them, meaning that it will be on the debit side there will be an interest, and on the credit side there will be a decrease there. So, okay, let's just repeat this one. Advertising expense, okay, advertising expenses, they will interest on the debit and decrease on the credit side. Now, when we pay expenses, we always record that on the debit side, because expenses interest on this side and they decrease on that side. Right. Okay. Now let's continue with the. Okay. So this is a summary of the equity. Now we will go now to the owner's equity. I mean to the liabilities. Now let's continue with the liabilities. Liabilities, they will always interest on the credit side. The example of a liability, it will be a trade payable. A trade payable. Then it's an example of a liability. Trade payable is when we buy something on credit. Let's say we buy stock at our wholesalers on credit for 25,000 rand. So that money will go on the credit side. Then a contract account will always be bank on that side, right? Okay, that is an example of a liability. Another example of a liability will be an accrued expense. Now, accrued expense is expenses that we have been paid. We're supposed to pay, meaning that there will be interest on the credit side and decrease on the debit side. Meaning that maybe we are supposed to pay a rent, but we didn't pay. Meaning that rent of 25,000 rand, for example, will go on the credit side, and maybe the rent, maybe say it's a rent, so we're gonna just say rent expense. So we are owing the lesser, the person who we are renting to, and then we are actually going to have maybe let's say that we borrowed a loan from the bank, so it will be like mortgage loan. Mortgage loan will always as well interest on the credit side. Let's say that the bank has given us how much? Given us 1 million rand loan. That loan will be deposited into our mortgage loan account on the credit side, right? And then the contra account will be bank. Ne? Then if you do the bank account as well, you just do this and then plus and minus 1 million rand. 1 million rand, and that will always write the contra account as mortgage loan on that side. Then you are done with the liability. What you must know and note about liabilities is that a liability, it's money we owe to our suppliers. Owed to our suppliers. Suppliers such as bank, and creditors. So those are the people that we owe money to. So the businesses usually owes money to the bank, or they owe money to their creditors. Remember, other businesses, they can't survive without a loan. So they always go to the bank and borrow a loan. So that's how they become actually liable to the bank. As well, we also buy goods on credit, because usually the businesses, they can have money later on after selling their products. So they actually just buy the goods on credit. So we're gonna owe our creditors. Yeah. So about the liabilities, this is how it is. This is how we can close it here. But now let's just do a summary of what we have just done. Now let's continue. Now I'm just summarizing what we have already done here. Now we have spoke about assets, ne? Assets, we have spoken about owner's equity. Owner's equity. Now we spoke about liability as well. Liability as well. So what you must get and catch out of this is that assets is ownership of the business. It's belongings. You can say belongings. Then another thing is that it's the ownership. It's what the business owns, not the owner of the business, but what the business owns. Yeah. And as well, we have that we actually mentioned that we have vehicle, we have land, ne? We have land, we have land, and then we have equipment, ne? Equipment, we have furniture as well, furniture of the business. We have machinery as well. Like business like Sasol, they own machineries. The machines that they use to produce whatever they are using. And then we have equipment. Okay, now these are the assets. And then you must note this about assets. Assets, the assets are debit balance accounts, meaning that they increase on the debit and decrease on the credit side. So assets, they have a debit balance. A debit balance. Those are assets. And remember that assets increase on debit side. Always. Debit side. So debit side go plus. Credit side is a minus. Ne? It's a minus. That is an asset. Go to equity. Equity, we spoke about equity. We said that equities, they have two sides, credit side and debit side and credit side. This side is a plus, this side is a minus. And then we said that the debit side of the equity represent what? Expenses. And the credit side represent what? Represent income. Represent income. That is the credit side. And then we said that let's go to the expenses. Expenses, we said, expenses, they have what we call a debit side, and a credit side. Now, expense will always increase on the debit and decrease on the credit side. Then we said about income. We said income, credit side, they increase, and debit side, they decrease. Those are the income accounts. Ne? Debit side, increase, decrease, that is the income, and the credit side, they decrease. On the credit side, they increase, those are income. And on the debit side, they decrease, those are income. But expenses, on the debit side, they increase. On the credit side, they decrease. Those are expenses. Okay, now I think we are done with this. But now we must know that our assets always equal to owner's equity plus liabilities. Thank you very much for watching. I will see you in the next video just now. Thank you.